Yo, welcome to another episode on popular demand. Every time there is a tragedy, me and Samay gather together to hear about how things went down with Papa Storyteller himself, Kash Danda, here with us today for another edition of Storytime with Kash. By the way, Kash is launching his own YouTube channel and his own Twitter account called Storytime with Kash, where you guys can go, where Kash will break down other minor tragedies that we won't be covering on this channel and tell you stories about the world. Kash, what's been going on? I've been hearing all kinds of things about Silicon Valley Bank and it being shut down. What does it mean for us and how fucked are we?
As usual, we are moderately fucked. And the rest of this is going to take us through how that happened.
Hey, can we start from the basics, man? What is a bank?
What is a bank? What is money, really, when you think about it?
Yeah. What is silicon?
So to give you some context, Samay, there was a bank called Silicon Valley Bank. Recently, the bank was shut down. And then you'll know the story of
Was
why.
some national holiday?
Not because of a national holiday, not because of Makar Sankranti or anything like that, because of something bad that happened. Kash, tell us what happened.
Shit, man.
That's right. So the premise of this video, the way I want to approach this, is to think about who killed Silicon Valley Bank, right? Because there is a dead body here, and there's a lot of people that might be responsible for it. And honestly, it's a pretty surprising dead body because Silicon Valley Bank went from being worth $18 billion on Tuesday to being worth $0 on Friday, right? So like almost within 2 or 3 days, all of the value is wiped out. They had 8,500 employees and more than 37,000 customer deposits, all which were suddenly put into jeopardy. And so what I want to do is I'm going to present you guys some facts, and then you tell me who is responsible for this death. Meet Greg. This is Greg over here. Greg, like everybody else, just wants to be cool. And he decides the best way to be cool is to throw a party. And as he's deciding to throw this party, he makes 3 pivotal decisions. The first one, he invites only the bros, right? His wife is like, hey, won't the party be nicer if there's a mixture of people? He says, no, I only want the bros. They really know how to party. Decision number 2 that he decides to make that's pivotal. He says, hey, anybody can have a party in a bar or a restaurant or whatever. We're going to have this party up on the rooftop. That's going to be even cooler. Yeah, so he finds this like 50th story rooftop to go have the party on. And then the third decision that he makes that's pivotal is he decides to remove all the railways from the rooftop. That way everyone can get some really like sick Instagram pictures and look really cool and everyone's going to be very happy, right?
Damn.
Weird idea, but he decides to go with it. And he decides to throw the party, and the party kicks off, and he's having a great time. Greg is loving life. He's super popular. All the bros love him. Life is good, right? Until it starts to get really windy, and the weather starts to change, and that starts to kill the vibe a little bit. But Greg decides to keep partying. He says the party must go on. But then the alcohol starts to run low as well. And a party without alcohol can get a little bit dicey, right? So Greg gets up on stage and he says, hey guys, don't worry. I've just bought some more alcohol. It's on the way. Everything is fine. But if anyone wants to chip in for a 10-minute alcohol delivery, so there's alcohol here sooner, that would be really cool. The bros hear this and mayhem erupts, right? Everyone rushes to the bar to get the last drinks while they can. And in the stampede, the bros actually knock Greg off the stage. And because it is so windy, it forces him off the ledge of the rooftop and he's in free fall, falling down 50 flights of stairs in the open air, hoping for a miracle for somebody to save him, and no miracle comes. And then Greg dies. And this is how we get our dead body.
Damn. That's why I always party on the ground floor,
That's
guys.
the lesson.
That's the takeaway.
No, but where did this party? Was it something like the SVF party?
This is a metaphor, Samay. It's a metaphor. This is not what actually...
There was no actual party.
This is not an actual
Why do you always confuse me, Kash, by giving me some example and then you say it was all bullshit?
The first thing, obviously, Greg is Silicon Valley Bank, right? And like all people want to be cool, Silicon Valley Bank wants to make money. Fundamentally, it's about greed and making some return on the deposits that they have. And so when they want to throw this party, they want to invite all of the bros, who in this case are all the VCs and the venture-backed startups that work with them. This is going to end up being a problem, right? There's a little bit of foreshadowing here because when you have only one type of person at a party, you have a lot of customer concentration, which is increased risk, which we'll come back to.
But they had other types of customers as well, right? A lot of small businesses as well.
They did indeed. They banked something like 51% or 55% of all companies that IPO'd, though. And that's where most of like the mega deposits were coming from.
So do they get to choose who they want to give the money to?
It was a bit of like a strategic decision on their part of like, hey, let's be the bank that has a niche, right? And in general, having a niche is useful. It makes it easier to find customers and whatever else. You have a really clear value proposition. So they just chose VCs and startups as their target demographic.
So a lot of VCs and startups, they would put their deposits in Silicon Valley Bank.
They just gave all the emails to only VC guys, basically.
No, not like that.
It's like your YouTube channel, right? Like most of them are comedy fans, but some of them are there just because you're so good looking, right? And they just kind of sneak in, even though the main product is not made for them. Correct.
Now this is a metaphor I understand.
The second part of the story, right, is this idea. So they invite just the bros, right? So they have customer concentration. The second piece is that they decide to do this party up on the rooftop rather than on the ground floor. What that actually means in practice is that in order to make money, right, because again, that's their main goal, they needed to take a little bit of risk. And they decided to invest all of the customer deposits into these long duration mortgage-backed securities, right? So people might remember mortgage-backed securities from the Great Financial Crisis. In this case, the actual securities were fine. It's not a big deal. Like there was nothing weird or risky going on here. The problem, which will come up later, is just that they are long dated. They have a long duration.
Now, hang on. Samay is looking confused, so let me explain it. Okay. Samay, in every country has something called a budget. Like you must have heard that India has a, February mein har saal, finance minister comes and reads a budget. Now, what is a budget? A budget is nothing but the country's balance sheet. Every country needs to have a balance sheet, right? Ki how much profit are you making? The government makes a bunch of profit and they reinvest it into infrastructure, education, etc., etc. Now, sometimes when the country needs to raise money from its people, they launch something called bonds, right?
I thought it was called tax.
Tax also, but they also create different bonds. In this case, MBS is mortgage-backed securities, which means these are bonds which are backed by real estate, backed by houses. So people can buy these bonds and the government guarantees that you will get X interest on these bonds. You went and deposited 100 rupees in the bank. Now, like this, there are 1,000 customers, so the bank has 1 lakh rupees. Now, banks can make money in two ways. They can either take this money, invest it somewhere and get a yield on it, or they can lend it to customers. And customers, if you give it to someone at a loan, they get whatever, 6%, 7%. Now, the difference usually is what they make. That's called the spread. That's what they usually make. In this case, between 2019 and 2021, Silicon Valley Bank had so much money come in that they decided that let us buy these government issued bonds, which is called MBS, mortgage-backed securities, which were giving 1.5% interest.
But why so low interest they went for? Was it because they didn't have enough people who were asking for the loan?
No, so that's exactly right. So most banks make money by loaning out, as Tanmay says. It just so happens that if you are a venture capitalist or a startup founder, you don't need loans over the last few years because interest rates were very low and there was lots of investment coming in the space. These guys were flush with cash. They didn't need the loans. And so Silicon Valley Bank couldn't do the normal thing, right? Like Greg can't throw a normal party. He has to throw a different type of party. The reason they go for these mortgage-backed securities is at the time, so this is like 2018, 2019, 2020, as interest rates are going down and becoming zero, there's no other way to make money. If they can't make money through loans and they can't make money through buying treasuries, which are very liquid deposit or created by the government, they have to go somewhere else. And that's where they go to these mortgage-backed securities, which were not that risky. I want to be very clear about this. They had a yield of 1.5%. Oftentimes, if you're making loans out to your customers, you're getting at least 2% back, right? So these are in some ways less risky than actually loaning out to your customers.
Now, when Kash says interest rates were low, what he means by that is that the Federal Reserve, you'll often hear in the news that the Fed is increasing rates or the Fed is lowering rates. What does this mean? Now, the Fed effectively is the state. Okay, they decide whether interest rates will be low or high. Now, what happens is, think you're a bank, okay, and the government says that, hey, I'm increasing interest rates on bonds. Okay. So the bank will be like, acha, government 6% de raha hai. So they'll go invest with them. But if the Fed lowers rates, government says that we'll only give 1% or 2% on our bonds. Banks will be like, but if I give loans to customers, if I give loans to people or businesses, they are willing to take a loan at 6% interest. Which means that when the Fed lowers rates, loans increase, which means credit increases in the market, credit increases in the economy. And what happens when credit increases in the economy?
Spending power increases.
Spending power increases. But when there are zero interest rates, that's what Kash means, because the interest rates that government was offering was very low, 0%, 1%. That time, a lot of everyone was giving away credit. That's why we saw a lot of growth in the last 10 years. That's why we saw like a bull market, right? In fact, after COVID, everybody in the US got some $1,500 in their bank account. So people had a lot of credit they could spend. And when there's a lot of credit in the market, markets go up. Because what do people do with credit? Sometimes they'll use it to grow their businesses. Sometimes they'll use it to reinvest it in the stock market.
Sometimes they want to lose it all in crypto.
Which a lot of people did on Robinhood.
Yeah. I was hoping you wouldn't get to that. But this is what Kash means by lowering interest rates.
So you're telling me that there was a time in 2019, 2020 or 2018 where you were only getting 1.5% interest rate from the banks.
No, what I'm telling you is that there was a time for 2 years actually that you were getting 0% back from the government, which is very, very rare. When the government is not giving you any extra money, right? The government bonds, these treasuries as they're called, are the safest thing that exists. Right? Because it's the US government. If the US government goes down and doesn't pay back their bonds, the whole world is over anyway, so it doesn't really matter, right? So that's what's called the risk-free rate. You take no risk by buying a treasury bond, and when the interest rate is 3%, then the risk-free rate is 3%, which means that everyone else needs to offer more than 3% return for whatever they're doing. Otherwise, why would you buy it, right? If you're offering me a loan at 2%, I get 3% from the government for no risk, I just take that instead. But when interest rates are at 0, everything else becomes more attractive because you have to put the money somewhere else because you can no longer put it in treasuries. And that's how the interest rates affect how much investment is happening in the other parts of the economy by basically saying, hey, don't put your money with us. Put your money elsewhere. It creates more investment. And when interest rates are high, like they are like right now at the recording of this video, everyone is just kind of putting their money in treasuries. And there's not very much investment because it's harder to beat the risk-free rate.
And this is why when interest rates go up, lending and loans go down, which means that the economy is tightening, which means that there's not enough credit in the market. And when interest rates are low, there's a lot of credit in the market.
So in the same way, to take it back to the story, in the same way that having a party on a rooftop is in theory riskier than having a party on the ground floor, because you can't fall off the ground floor and you can fall off a rooftop, it's not all things considered that risky. Unless they removed all the railways. Remember how weird that part of the story is? They decided to not hedge this investment that they were making. So in the real world, if you do this kind of investing with these variable interest rates, or these fixed interest rates, when you do this kind of investing, you're taking on some risk, right? Because if you're buying something that's paying out 1.5%, and then the federal interest rate rises, all of a sudden your 1.5% is not worth a lot of money, right? Because if the government is giving me 4% and you're only giving me 1.5%, no one really wants to buy that thing anymore. What every bank in the world does, and many people do, is they use something called interest rate swaps. We don't have to explain what it is, but it is the way that you hedge interest rate risk. It's basically buying insurance that says, hey, if interest rates rise too much, I'm not going to get in trouble. SVB did not do this. This is as crazy as removing the railings from a rooftop. And they did this all, by the way, just so they could get an additional 0.4% yield. For this tiny little benefit, they took on this massive additional risk.
0.4% yield of like $100 million or something stupid like that, right?
The risk return seems very off to me and to everyone else, right? And this is actually a statement from their financial reporting that came out in Q4. You can see here, right? If you, down here under Q4 2022, the portfolio duration is 5.6, right? Hedge adjusted, still 5.6. That's not good, right? You need to hedge a little bit. It's crazy not to. So anyway, this wasn't a problem for a while. For years, this worked fine because there was more and more funding for VCs and there was more and more funding for startups. And so their customer deposits kept going up in this low interest rate environment like we talked about. Here you can see their deposits nearly tripled or quadrupled in the span of 3 or 4 years, which is crazy, right? Tons of money was coming in.
But why would people invest when they know they're only going to get 1.5%?
People weren't getting 1.5%. The bank was getting 1.5% by investing in these mortgage-backed securities.
So how much was people getting? Probably lower than that also.
People were getting 0% at the time.
So why would people invest in this then?
They didn't invest, but in a bank, right? So let's say that you're a startup and you've just gotten $10 million in a check, in your Series A check. You have to put the money somewhere, right? You're not going to keep it at home.
Where do you put your money, Samay? You put it in a bank, right?
SBI, FD.
Correct. So whatever, FD or your savings account, you put it somewhere, right? So a lot of startups, when they raise money, they use this Silicon Valley Bank as their bank. Now the bank gets these user deposits. They have to do something with that, right? पड़ा है बैंक में.
The benefit that the user gets when they make the deposit is that their money should be safe. You're trading that safety, and you're saying, hey, you don't even have to pay me. Just keep my money safe. You use it for yourself. That's good enough benefit.
So they're not doing it to make money. They're just doing it to not lose money.
Yeah, they just
Correct. The startups
that
and the
makes
VCs.
sense.
it's a deposit.
That's
They
right.
just deposit it. They didn't invest.
So they put it in the bank and the party is going fine, right? So Silicon Valley Bank is growing like crazy. At this point, it's a top 20 bank in America. So it's really going well until, remember in the story, the wind starts coming and the party vibe starts dying a little bit, right? The wind is the interest rates. Interest rates happen at a way that is not controllable by Silicon Valley Bank or anyone else. They're almost like an act of God. It's done by the US government. And so in this case, you can see interest rates rose really, really quickly. So the wind on the rooftop grew really, really quickly. We went from basically zero up to 4.5% in the span of like 2 years, or in the span of a year, really. And this caused a lot of problems. This started to hurt the vibe. And what that means in practice is that when it gets really windy, when the interest rates rise, the value of bonds goes down. Right? This is just a general economic phenomenon, and you can see it here. There's an inverse relationship between interest rates and bond prices. I think we probably don't have time to explain it, so just take it as true. When interest rates go up, bond prices go down, and when interest rates go down, bond prices go up. So in this case, the value of all these bonds, these mortgage-backed securities that Silicon Valley had bought became much less valuable really quickly, because the interest rates went up so quickly.
Now think about it, right, Samay? Imagine you invested somewhere that was giving 1.5%, but you get a very, very safe investment with the government for 4.5%.
I will remove all my money from here and put it there.
You would want to, right? And so this is the general problem that is faced, that if you're fully liquid, no issue, right? And when we say liquid, it just means it's easy to get, if anyone hasn't heard that phrase before, right? So like treasuries, which are the kind of bonds issued by the government themselves, are very, very liquid. Multi-trillion-dollar market, lots of people want to buy them at all times. They're fully flexible, it's no problem. The issue here is that these mortgage-backed securities that we talked about earlier, they are not so liquid. In fact, you have to hold them to the duration. They're meant to be 10-year bonds, right? And the problem is, as interest rates go up, in order to sell them and switch to the better thing, to switch to the treasuries, which pay more, you have to sell at a loss. And that is where the problems really started to become an issue, right? So now it's getting very windy at the party. Interest rates are rising. And then to make things even worse, in addition to the general vibe of the party getting worse, the alcohol starts running low at the party. The alcohol here is like the customer deposits, the money that's actually in the bank, right? The reason the customer deposits decreased is because there was less funding, right? So less new startups were getting funded over the last year because interest rates were higher. And these startups were still burning lots and lots of cash because they had hired all these people. So they started with $10 million in the account, and that number mostly just goes down. And if there's not new funding coming in, then the bar just gets lower and lower.
So you're saying that people and companies who are actually, they wanted to remove their money, but they couldn't.
I'll explain. Now, Samay, imagine if you are Silicon Valley Bank, okay? You had 20 rupees. Now, 10 rupees you invested in these MBSs, which were giving 1.5%. Then you have 10 more rupees left. These 10 more rupees are the deposits that your startups and all have made. But in the recent times, in the last year or so, VCs are raising less money from LPs. Startups are still continuing to burn more money. तो जो 10 rupees है, वो कम हो रहा है ना, क्योंकि customers तो निकाल रहे बैंक से, किसी को salary देना है, पेमेंट करना है, burn हो रहा है, startup का हर महीना जा रहा है. तो 10 rupees कम हो के 3 rupees बन गया. So earlier 10 rupees you put in the bonds, but the 10 rupees that you had, that also is getting kharcha. And new deposits are lesser and lesser. क्योंकि funding वगैरह कम हो रहा है ना, everybody started realizing that, the economy is going through a tough time. So lesser money was being raised. So they couldn't use that additional 10 rupees to buy the other bonds at 4.5%. So they couldn't hedge their 10-year mortgage-backed security. They couldn't hedge it.
But why do they care? Because people who had invested at that time when they had put for 1.5%, they have to...
Think about it like this. The customer deposits are the alcohol. They're the thing that keeps the party going. There is no business if there are no customer deposits, right? In the same way, there is no party if there's no alcohol for these people, at least, right? The issue here is that they took some of the alcohol that was there before, basically, and they invested it off. They kind of sent it away. They said, let's put this in a warehouse for now. We won't need it at this party right now. We have plenty of alcohol. We can use the excess. Let's put it over there. But once the alcohol starts to decrease here at the party, that creates a problem. They need to get more alcohol in. And the only way that they could start to get that alcohol in is by actually selling the mortgage-backed securities that we just talked about for additional liquidity. That's how they have to restock the bar, right?
तो जो दारू वेयरहाउस में बेचा उसको वापस लाने का ट्राई किया, पर वो लॉस पे ला रहा है वापस. 100 बॉटल भेजा तो 80 बॉटल्स वापस आ रहा है.
Exactly. And so what actually happened here is it's even worse than that, right? SVB had to sell $21 billion of these securities and took a $2 billion loss. That's a lot of money to lose, all because they had invested in these long-term duration things that were not as liquid and couldn't be sold as easily. So they say, hey, we're going to do this. And then just like in the story, Greg is like, hey, there's more alcohol coming. Don't worry. They do this and say, hey, don't worry. Their money's going to be fine. We have the money. But then they make another critical mistake. They say, hey, just in case, if you would like, try to give us some more money so we can buy alcohol faster, right? We'll get the 10-minute delivery. That way it's here. No one has to wait, right? In real life, what happened is that they tried to do what's called a capital raise. They went to the market and said, hey, don't worry. Yeah, we had to take a loss, but we're fine. But hey, wouldn't it be nice if we just got another $2.5 or $2.25 billion just to be safe? Just so that the bar is fully stocked, right? And not surprisingly, when in the real world people heard this, they lost their shit because everyone got very worried that, oh, there's not enough alcohol and there's not going to be enough alcohol coming. They are not telling the truth because if they were telling the truth, then why would they want another $2 billion right now? And as a result of this, in a single day, $42 billion was taken out of Silicon Valley Bank. Everyone rushed the bar at the same time to make sure that they could get a drink before they left.
This is called a bank run. Everyone goes and they start taking out your money from the bank. तो बैंक के अंदर पैसा ही नहीं है, liquidity नहीं है, right? So this is the problem.
The bar is empty. This is a thing that can happen to any bank. No bank in the world has all of the customer deposits available at the same time. No bank keeps all of the alcohol behind the bar. Every bank uses this warehouse model where some is here, little bits are here, and there's some over there. If everyone ever tries to come at the same time, there will not be enough for everyone. People are going to have to wait until it comes from the warehouse, right? And that is the nature of the bank run because no one wants to be the last one there. No one wants to be the person waiting. Inside of hours, Cotu, Y Combinator, Peter Thiel, etc., all told their portfolio companies, take your money out of the bank. It's not safe. And when everybody tells all their people at the same time, that's the commotion of all the bros going crazy.
Damn. So you're telling me that if we all tomorrow say that remove all your money from X bank,
Yes.
then that bank is
That
gone.
bank is wrecked.
That bank is gone.
Oh my
So
god.
usually there's a rule. It's called a fractional reserve. Cash, am I right? That every bank is supposed to have. Suppose I am a bank and I have 100 rupees. At any given time, I'm supposed to have X% of it ready to give it back to customers. Sometimes it's 10%, sometimes it's 20%. I forget what the number in India is, but this is called a fractional reserve.
The really critical piece to appreciate about this, though, is that this is how the entire economy works. This is literally how money is created. A bank takes in $10 and they loan out $9, right? They have created $9 of money in the world. This is the basis of the entire economy. And when people find out about it, they're like, wait, this sounds like a Ponzi. Because it kind of is, right? Like, this is how banks work. Now, it works pretty well. It's worked for the last 80 years or so without too much problems, except for the Great Depression and now this and a few other major incidences. But in general, it seems to work.
And the money that people deposit, the bank can do anything with it. It's on them, right? Or do they have to tell us, look, this is what we're going to do?
Going back to Tanmay's point, there are capital reserve requirements. So you have to have some there. With the others, you can kind of do what you want. Now, it is the job of the regulators, in America in particular, to say, hey, you can do this, you can't do that. So there are some rules around it.
So tomorrow if I open a bank and I take money from you, I take 10 rupees from you, I take 10 rupees from Tanmay, and I can then put it probably in crypto
Correct.
as
You
well,
can
right?
do anything you want.
You could.
Yeah, you could. This is why it's very hard in India, especially, to get a banking license. It's
Correct.
a banking license hasn't been given out in the last 20 odd years or something like that. Okay, किसी को banking license मिलता ही नहीं है. It's very hard because people's money is at stake, right?
It's so much power.
So much power.
Yeah.
Technically, imagine if thousands of people put their money in the bank and the bank is using that money to make more money. You have given a loan to the bank.
Yeah.
Technically,
That's
right? So that's why
exactly right.
That's why now there is chatter about, is your money even safe in the bank? And should banks have a new feature where they say, hey, give us your money. We will not do anything with this money, but you give us a fee to just keep this money safe in the bank.
Why don't we directly buy bonds?
You can directly buy bonds.
Why don't we directly give loans?
You
then?
can you can't,
Well, I don't want to go too much into the crypto part of this all here, but this is kind of the point of DeFi, right? Of decentralized finance. The idea is, hey, we don't need this middleman who's taking all the fees. Let's all just do it ourselves, right? So that's why you can go to Aave or you can go to Solend and make loans and get the interest yourself directly.
Okay, so if anyone needs a loan at 50% interest rate, let me know.
Whenever someone is giving you yield or interest, This is what's happening at the back end. They take your money and they are making more yield from somewhere and keeping that 1-2% in the middle. तेरे को 4% पे दे रहा है, किधर और उसको 6% मिल रहा है, उसका 2% का प्रॉफिट हो रहा है बीच में.
Mayhem as everyone takes their funds out. And then there's this commotion, like we said in the story, where the bro's going to knock Greg down and rock him off. This is maybe the saddest part of the story, in my opinion. These bank runs happen because people get very scared and this panic spreads. But if no one gets scared, then there's no bank run, right? Because then there's not this rush to the bar to grab the last bottle of alcohol. If everyone is just cool about it, the alcohol will eventually come and life will be fine. Silicon Valley Bank was the primary bank for venture capitalists and startups, who then turned on Silicon Valley Bank in an instant. After 40 years or 50 years of service, within a single day, all of these VCs stabbed their best friend in the back. The one bank that had been there for them and all of their companies, when the first sign of trouble, they all decided to say, hey, take your money out, knowing that it would actually hurt SVB and make them more precarious and start to create this bank run. So there's an element of this that is really like Judas, stabbing a best friend in the back, which is painful to see.
Yeah, that's why they say, guys, hoes before bros.
Let's just make up a crazy example, completely unrelated, right? Samay and Tanmay, you guys have been friends forever. Let's say that for whatever reason, Tanmay gets canceled. I know that would never happen, but let's say he did,
yeah,
right?
That never happened.
You have an option, right? To either stand by your friend, in which case the canceling will be less because there's less noise around it, or you can start to whisper to other people like, hey, Tanmay might get canceled. I don't know what's going to happen here, right? It's not cool for you to do that, in my opinion, but it's understandable why they did it in this case, right? Because if they didn't do it, then their money could be lost.
All the fucking examples that you could have picked.
You chose the truest one.
As we go to this, right, they knock him off the building. And because it's so windy, the interest rates are so high, there's no chance that they really recover from this. And so there's no chance of short-term turnaround. That's why the wind blows him off. And then as he's falling in the story, what that represents is that the stock price is falling dramatically. It's falling 60% in basically 24 hours of active trading time. It's trading like a real shitcoin, right? Which is crazy because it's a multi-billion-dollar bank. Their only hope is that a miracle happens and that the Federal Reserve steps in and saves them and bails them out. That does not happen. Fall to the ground, they die, and they're eventually taken over by the FDIC. So RIP Silicon Valley Bank.
At that time, when the guy who owns the bank, he knows that his thing is going down, can't he short his own bank from another account or something?
He can. That's called insider trading, though, and he will definitely go to jail.
Okay.
In fact, I saw some tweets saying that the CMO of the bank and all these guys had started selling their stocks a few days before only.
And that's not legal.
It is illegal. It is definitely illegal. Unless they had scheduled the sells in advance. So like what a lot of executives do is that they will, if you want to sell stock, you have to say, I'm going to sell it in 6 months, like come hell or high water. So that's I don't know what the exact angle was here.
But why can't they just tell a random friend of theirs, hey man, look, I'm getting fucked. So if you can just short me and then the money you make, they can, right?
Yeah.
Do you remember Martha Stewart and how she went to jail for insider trading? That's what happened. She had a friend who called her up and was like, hey, this thing is going to happen in the markets. And then she went and traded and then she got caught.
But how will he get caught when it's clearly going down? So people are like, obviously he shorted this. It's not like some crazy idea he got.
For publicly traded company executives, there are specific rules about what they're allowed to do and not do. So they cannot just decide tomorrow to sell something. They have to do that 6-month time limit or whatever it is.
That man is very foolproof.
There's a lot of money at play here, buddy. They have figured this shit out on purpose. Overall, I think for me, this is one of the key takeaways is that we have unlocked a new type of disaster, which I'm calling hyper panic. And the idea is, back in the day, 50 years ago, it was harder to have these bank runs because it was harder to coordinate among all the parties. And critically, information moved at the speed of newspapers. Nowadays, information moves at the speed of Telegram group chats. So when you have a lot of customer concentration and it's very easy for them to all talk to each other, you can get this panic happening at hyper speeds. Interestingly, I think this is a similar thing that happened to FTX. If you remember in the FTX video, there was something like $4 billion of withdrawals in a single day. And it was the same kind of hyper panic dynamic where all crypto people know a lot of crypto people. FTX only worked with crypto people. So when you have this concentration of customers, everyone panicked at the same time. And so you get these crazy volatile things happening that don't normally happen. The flip side of this, by the way, I think is the meme stock kind of phenomenon, right? That's like hyper growth for stocks where everyone's on Reddit talking to each other, sharing information very quickly. And so everyone can buy all at the same time and coordinate on the way up and on the way down.
Does this now in any way affect the money I have put in my FD in SBI?
I think you're fine, Samay. I think you're fine.
I would say that it affects you in the sense that this could be very bad for the global economy, or it could be very good for the global economy. Because of this, it is now more likely that the Federal Reserve is going to cut interest rates. And remember what we said earlier, right? When interest rates go down, the party starts up again. So interest rates go back down to 1 or 0%. Crypto, equities, all risk assets are going to do very, very well. So this could be one sign that the bear market is ending. Could be.
Maybe. Who knows?
Not sure. Exactly.
Not sure.
Maybe. Yeah. This is not financial advice, obviously. Like
There's no guarantee that the Fed is gonna lower rates. There's nothing of that sort. Awesome. Thank you so much, Kash, for explaining what went down with Silicon Valley Bank. You guys can go check out Kash on his new YouTube channel. Samay, आज कुछ सीखा कि नहीं?
भाई बहुत कुछ सीखा यार.
मजा आ गया ना? यार जब भी दुनिया की गांड लगती है हम तो कुछ सीख लेते हैं भाई.
मजा आया था bro.
On that note, see you guys next time. Bye bye.